Hey, good afternoon, everybody. I want to welcome you to our event today, monthly Max Payne, July 13th. You got John Hopkins here. Going to be joined today by Tom Bowley and Aaron Weber as we delve into the options expiration coming up Friday and what that might look like. I can't wait to hear myself. If you're new to Earnings Beats, we welcome you. Really appreciate you giving us a try here and hope you enjoy what you see. Of course, we want to welcome our seasoned veterans. Thanks so much for your great support over the years. This event will be recorded, so you'll be able to listen at your leisure. For some reason you can't stick around or something you want to go back and review, you'll get a copy of the recorded event a little bit later today. Anyways, I know there's a lot to cover here, so I'm gonna get right over to Tom and see if he and Aaron are ready to roll. How's it going, Tom?
It is going well. How are you doing, John?
I'm doing good. I hope you don't get it that thunder and lightning you got yesterday.
Oh man, that was wild. I tell you, we had a lot of lightning strikes right around me, so it was a little scary being on the computer because I was afraid something might come through. But yeah, all's well, and much sunnier
Okay.
today. I think we'll be good.
Same here. I'm gonna just step aside so we can get this thing rolling. All right.
All right, sounds good. Do want to welcome everybody here for Max Payne webinar. We do this once a month, so we're pretty excited. Got a little extra special presentation for you. Aaron Weber will be going through a brief little tutorial on how to use a new tool that she's developed. And I guess before we really get into things, I'll just bring her in here for a second. Aaron, how are you doing today?
Hello, I'm doing great. I'm
That's
very
awesome.
excited to be here. I feel like I'm always behind the scenes, so it's fun to be participating, and welcome to everyone here. I'm excited to be here.
Yeah, it's always, I tell you, Aaron does a lot of work behind the scenes, and she's right. I mean, she is usually behind the scenes and probably doesn't get nearly the credit she deserves, but she's done a lot for us at Earnings Beat. You've probably seen a lot of her work on the website, but you'll get an idea. I always said that, having practiced public accounting for so many years, I always say I never met a spreadsheet I didn't like. But I would say that Aaron maybe takes that to even the nth degree. She's so much better on Excel than I am. So anyhow, we're going to have her come in here in just a minute, but let's go ahead and pull up the agenda and just talk about a few things that we're going to do tonight. So of course, the introduction, again, welcome to all of you for being part of this webinar tonight. We're excited to present these webinars. One of our missions at Earnings Beats is to educate. We like to think of our service as a research and educational platform. And so tonight is just one example of some of the work that we do where we try to educate our members and hopefully help all of you trade a little bit better, using some of these things that we talk about. But we're going to get into that new Max Payne tool demo. So Aaron's going to walk everyone through that. And then I'm going to talk a little bit about the June results from last month's Max Payne webinar, what worked, what didn't work. And then we'll go through July Max Payne candidates. We have a few more candidates this month because I put Aaron's tool to work, and she actually did a couple of calculations using this new tool that she's going to demonstrate for everyone. And this new tool will be available to all of our annual members to be used. You can download it and then use the tool to take a look at any of your individual stocks that you're interested in. I think once you see how it works, obviously, if you have any questions, you can write into us at support@earningsbeats.com at any time. But I think once you see how it works, and I think you'll find it to be, very useful and somewhat easy to navigate once you get used to it. So I'm really looking forward to going through those Max Payne candidates. And like I said, I think that this will be something that'll really help everybody. So I'm going to turn it over to Aaron for a couple minutes. Aaron, I'm going to let you take the screen and just take it away and show everybody what you've been working on.
Great, thank you. Okay, so I pulled up the new tool that we have, which is the Max Payne calculator. And for those of you who have been with us for a while, you'll probably recognize the overall appearance of the calculator because it's very similar to what Tom has presented every month. The difference is that Tom is very good with mental math and can solve for the max payne price in his head. But we wanted to create a tool that is repeatable for any member, annual member, to use to solve for the max payne price for different stocks or ETFs. So like we said earlier, I typically am behind the scenes. Perhaps if you've been around, you've seen my name on an email before, or you've seen me participate in the occasional webinar. But for those of you who haven't heard me before, just a quick introduction. My name is Erin Weber. I am the VP of Operations here. Fun fact, I am Tom's daughter, and I, similarly to Tom, have practiced in public accounting. I passed the CPA exam back in 2015 and was quickly drawn to learning and development in the corporate role or in the corporate world. So I've really been enjoying my time with EarningsBeats since 2019, just developing tools and educating our member base on how to use them. So a couple of quick notes about this template before we dive into it. This template is designed to compute the max payne price for stocks or ETFs at a given point in time. It goes one step beyond using basic formulas, and it actually uses an Excel add-in called Solver, which sounds intimidating if you haven't used it before. But once you get started, I think you'll see that it's very easy to use. So I want to show you, just along with the calculator, a couple of tools that we've built out to help train you up on how to use Solver and how to use this tool. So you'll see on the home page or on the home tab of the calculator that there are two hyperlinks. One is for a video tutorial, which we have available for you on YouTube. And then another is for PDF instructions. And I will quickly show you both of those things. So I believe you should be able to see the YouTube recording. If not, Tom or John, feel free to let me know. But okay, great. So this is the tutorial that we have available on YouTube. This will be really similar to what I'm going to walk you through today. So if you have any questions following today's session, you can either refer back to this recording, or you can refer back to the tutorial that we have available on YouTube. And then we also have step-by-step PDF instructions with screenshots if you find that format more helpful. One thing I do want to point out is that Solver is an add-in in Microsoft Excel that you'll have to enable. I'm going to show you how to do that using my current computer, which is a Mac. If you're using a PC or even a different version of Excel, it may look a little bit different for you, but we've hyperlinked the article provided by Microsoft Support, which will tell you how to enable that add-in across different platforms. So just know that that's available. And we will jump back over to the calculation. So as Tom and John mentioned, this tool will be available for download by annual members following today's session. Once I turn it back over to Tom, I actually plan to post this live on the website, so you should be able to access it pretty much right away. And I'll show you exactly where you can find that. So if you go to our website, earningsbeats.com, and then you go over to the member area, I'm already logged in, but you may be prompted to enter your username and password. Once you do that, you'll be taken to the home screen where you can access, if you're an annual member, you can access the exclusive content under our stock service area. And then if you scroll down, you'll see the max payne calculator. And like I said, that will be posted during today's session. It's not there yet, but it will be. So a few limitations of this calculation that I just want to quickly mention. This calculator does not guarantee that a stock or ETF will reach or even move in the direction of the max pain point at options expiration. It's purely intended to be used for general directional possibilities. And as it currently stands, this is an information tool, which means that this tool computes the max pain price at a given point in time, but it does not currently provide any interpretation of that price or suggested strategies. I defer to Tom on that, and we obviously collectively defer to you because we don't know your trading style, but that's what this tool is intended for, is to be used by you in accordance with whatever suits your trading style. And then the last point that I want to make is that this overview will demonstrate how to use the tool and not the mechanics behind the computation of max pain. So I don't know, Tom, if you want to talk quickly about how max pain is computed, or if you'd like for me to jump right into the calculation, I'll defer to you on that.
Well, I mean, we can, I'll talk about it more later, but maybe for those of you who are very unfamiliar, maybe you haven't been in here before, I can just give you the 60-second version. But essentially what we do is when a stock has been moving up for a period of time, and if it's heavily traded in options, a lot of times what you'll see is that as the stock's been going up and up, more and more traders have been buying call options on that stock. And so as you get, if you're sitting at a 52-week high or even a more recent high, a lot of times that stock will have a lot of what we call in the money calls, meaning that a lot of those calls, the current price is above the strike price. So they could be exercised into stock. Meanwhile, if a stock's at its high, it probably has very little in the money put interest, because most folks will buy and sell calls and puts that are out of the money. In other words, the stock has to head in a certain direction before those puts and calls will be in the money. So a lot of times what we see is a stock that has a lot of in the money call interest and almost no in the money put interest. And essentially what max pain is it moves to a price point at which all of the in the money call premium is completely offset by all of the in the money put premium. I can explain this a little bit more a little bit later on, but the analogy that I like to give, which I think is a pretty good one, is that if you're old enough and you remember a seesaw, and how a seesaw works, just imagine all of the call money going on one side of the seesaw, and on the other side of the seesaw, there's almost no put money. So that call side is going to literally, you're going to be on the ground. Whereas the put side, you're going to be way up in the air with your feet dangling. The max pain point is where the value of both the calls and the puts balance and offset one another, literally to the point where if you're on the seesaw, both sides are even, both sides have legs dangling. So hopefully you can kind of picture that in your head. So I'll talk a little bit more about that when Aaron's done, but that maybe gives you hopefully a little bit of a sense of what we're trying to calculate here with this tool. So with that, why don't you take it back, Aaron?
Great, thanks. So like I said, this will just be a very quick high-level walkthrough, since we do have the YouTube recording and the PDF guide in place. So you'll see that there are a bunch of different tabs in the tool. The main reason all 4 of these tabs are the same, they're all the calculator template. And probably one of the most important things to know is that when you use Solver, it will consume some of the formulas in the spreadsheet. So once you use a tab to calculate the max pain price for a stock or ETF, you will not be able to use that same tab again. So what I do and what I recommend that you do is, if you right click on this template tab, you can select move or copy. And then if you check the box for create a copy, you can make a copy of the tab, which I'm going to do to show you how to walk through the calculation. So for today, I'm going to demonstrate SPY. Oops, I guess I should name it something different. And I do have an answer key just because it's already completed. So anyway, this is the template that we'll use. So first thing, I like to just enter in the ticker symbol so I know which stock the calculation is for. And then I enter in the current price. So when I did this earlier, it was trading at $436.99. So we'll enter that in. And then you'll see that you need to enter in data for the strike price as well as the calls and puts. So we use cboe.com for that data. And I'll show you an easy way to download the data and copy and paste it right into the calculator. So if you go to cboe.com, and all of these steps are written out in the PDF user guide, so you'll be able to see the step-by-step directions for how to access this data. You'll select the data tab and then click on quotes dashboard. You enter in the ticker symbol of interest and click search, and then select the options tab. And once you do that, you'll need to enter in a couple of filters. For volume, select all. For expiration type, select standard. For options range, select all. And then expiration, since we're currently in the month of July, I'm going to do July and then click view chain. And you'll see that this gives you all of the data that we'll need for the calculator. So if you scroll all the way to the bottom of the data, there's an option for download CSV. If you click that, it will download to your computer and you can open it up with Excel so that it's easy to copy and paste directly in. And I actually did that earlier, so I'm just going to pull it up. And this is what it will look like. There's a lot of data here, and most of it you won't use for the calculation. The columns that you'll need are the strike price, and then open interest, which is for calls. So you can see calls over here. And then open interest over here, which is for puts. So I'll pull the Excel files up side by side so that you can see. Okay, so next, it's really easy. All you do is you take the range of data and you copy it. So I just did Control-C or Command-C on my Mac, but you can also right-click and copy it that way. And then you paste it over. So I'm going to paste as values because I altered the formatting, but if you were to paste it as is, it would still work. So next, we have calls, the open interest that we need to copy and paste over. And same thing for puts. And one thing I like to check just to make sure is that the data range does not expand beyond the rows we've allocated for it. There are a lot of rows, so hopefully you won't have that issue. But if you do, you can insert rows anywhere within the range. And then you'll just need to copy and paste the formulas too, to make sure that everything works. So then now you have all of your data entered, you're ready to use Solver. Make this bigger. So I have it enabled. I'm going to disable it so that you can see what I'm doing. So in order to enable Solver, at least on a Mac and this version of Excel, like I said, if you have a different version, it may look different for you, but the user guide should be able to help you with that. So if you go to the Data tab in Microsoft Excel and you click on Analysis Tools, so that will display a dialog box, which gives you the option to check next to Solver add-in. and then you select OK. And you'll see once Solver is enabled that there is an option for Solver up under your data tab. So we're ready to use it. If you click on the max pain price cell, and I'm going to make this a little wider. So how this works, let me back up for a minute. This Solver cell is showing the call premium plus it's showing the net premium essentially, which is over here. So you'll see that 88 billion, it looks like that ties with the net premium, which we want that to equal 0 because that's the definition of what max pain is. So Solver is going to set the objective cell, which is C9, the Solver cell, to equal a value of 0 by changing the variable cell C8, which is the max pain price. So basically what Excel is going to do for you is run through hundreds of different scenarios, hundreds of different prices to figure out what is the price that makes that net premium equal 0. So I'm going to go ahead and run it. It takes a lot of processing power. If for whatever reason I drop off, this pretty much concludes the presentation. Once you run it, the price should come up with that 421.91. So before I run it, just in case I do drop off, one other thing I want you to know is that in the calculation template, we do have 2 example tabs, which are presented in the tutorial on YouTube. So to make sure that the calculator is working on your end, we've given you an answer key for AMC, which I believe that this was in June. So it will look a little bit different now, but we gave you the answer key as of June, as well as the sample data that we used. So you can go back and use this sample data in one of the calculation tabs to make sure that you get this answer. So with that said, I'm going to go ahead and run Solver. It can take up to a couple of minutes just because Excel is running all of those different scenarios. I don't know, Tom, can you still hear me?
I can. You're still coming
Okay,
in.
great. I wasn't sure how much bandwidth my computer has, but it sounds like we're doing okay.
Oh, it's great.
So right now it's running a bunch of different solutions. You can see down here that it's tried 55 different solutions, still running. Again, it's trying to find the price that will make this cell equal 0. And this is a great example because usually you'll have a dialog box returned which says Solver found a feasible solution. Here it is. This one actually says Solver could not find a feasible solution. However, the Solver cell is 0. The main reason that dialog box is displaying is due to rounding issues and nominal rounding issues. As long as this Solver cell is 0, this should be the correct price. And if you receive that message, just know that it may be slightly off as you get into the hundreds or thousand place values. So I think that that's everything I have. That 421.91 is exactly what Tom and I both computed earlier. So I think that that's everything I have. I don't know if there were any questions, Tom or John, that came in, or if you have any questions as you've watched this presentation.
Yeah, I mean, I don't see any questions. Yeah, I think everything's good. So either everyone is so confused that they don't know what to say, or you did such a good job that they understand.
The good news is I'll just be able to call Aaron.
Yeah, and
Yeah.
I mean, Aaron's really good too about answering customer support emails and so forth. So if you do have questions, feel free to reach out to us. And I do also want to mention, that we had a member, we don't have permission to use any names, so I'm not going to use a name, but we did have a member who was working with us and had given us a lot of really excellent feedback. It's somebody who worked with tools like this on Excel. And so I just want to say thank you to that individual, if you're listening. But yeah, well, I mean, it was awesome because I think Aaron did a fantastic job with this. I can tell you that as fast as I can put this together, I have to manually input the data, which takes a little while. And then, like Aaron said, I'm using mental math to go through and calculate this. And I'm literally taking it out to like 10 decimal points because I get it right down to the zero line. And I know with the Spider, the SPY, her max pain was 421.91, and I think mine was 421.92. So we were right literally within a penny of each other. So I'm excited about what you've done here, Aaron. I think, members, once you get used to it, it might seem a little intimidating at first, but I think once you get used to this, I think you can really use this to your benefit. And as you get closer to max pain, to at least be aware of max pain. It doesn't mean, like Aaron said, we've had months where we go through max pain and it just simply doesn't work because there are a lot of other things that work in the market. It's not just about what's out there with options. I mean, market makers can be buying the stock and selling calls. And so there's no guarantee that a price is going to go down just because a lot of calls have been bought. So there's a lot of different things to factor in. But before we move on, I just want to thank Aaron. That was a great presentation.
And let me toss something in. A couple of comments and then a couple questions. First, to thank you so much. Looks good. Looking forward to trying it out. It was a good, understandable presentation, not confused. Great tool. Thanks. Fantastic automated tool. Big thank you, Aaron. Now, a couple of questions. Would you get the same result if you use the function goal seek? I can't answer that one.
I'm not familiar with that, but I can look into that.
Okay. So whoever wrote that question, go ahead and just write to support@earningsbeats.com. Aaron will try to find the answer. With the basic knowledge of Excel, this was very easy to follow. If you do not save the results, are the formulas still overwritten?
Could you repeat that?
If you do not save the results, are the formulas still overwritten?
Yes, they are. So I believe, I don't know, you could try it and see. I recommend starting with a blank tab every time, but I don't think you would be able to use it again, even if you don't save the results.
Okay. Why are some cells of calls showing blank number?
So I'm assuming that's referring to maybe here.
Yeah.
And that comes from the data that we get from CBOE.com. So at that strike price, all that means is there are no calls. But as you scroll down, you see that there are a lot more calls at the higher strike prices.
Okay. We'll wrap it up here. Tom uses Numbers on his Mac, which is the Excel compatible program for a Mac. I do not believe that Solver works on Numbers. Does this mean I would have to buy a license from Microsoft Office for the Mac to make this work for me?
Potentially. I unfortunately am not very familiar with Numbers, and I'm actually going to meet with Tom to help him get Microsoft on his computer. So I'm not familiar with it. I can't say whether or not it exists on Numbers. I'm only familiar with Excel.
Okay, I think we have somebody on the staff that will be able to help with the Mac Numbers version if that's necessary.
Yeah, I also want to follow up too. The reason I have Numbers, I have multiple computers, and the computer that I use for my webinars is a computer that I've been using ever since I was doing shows at Stock Charts. And so this particular computer is pretty stripped in terms of, I didn't put additional software. I literally use this one computer for shows and for webinars and things of that nature. So this particular Mac that I'm using came with Numbers automatically loaded. So what I end up doing is I do all the work on Excel, and then I send myself an email of the Excel folder, and then I download it. When I download it, it automatically downloads into numbers. That's why when I present, you see numbers, but I've really struggled to try to use numbers. I use Excel. And so what Aaron was referring to is that we're going to meet so that I can get Microsoft Excel actually loaded onto this computer that I use for the shows. So going forward, hopefully next month, I will be working exclusively with Microsoft Excel when I go through and do the Max Payne webinars or any other webinars that I do. I'll be able to use Excel as opposed to
Okay.
numbers.
All the questions have been answered, so time to move on. Great job, Aaron.
Yeah, excellent job, Aaron. Great job.
Thank you guys for
Okay.
having me.
Oh, absolutely. You know what this means, though, because you did such a great job, you're going to be coming on more often.
I look forward to it. That sounds great to me.
Of course, the one thing I forgot to mention was we forgot to hit the recording button, Aaron, so you've got to do it again if you don't mind.
He's tried using that one.
I had to throw that in.
Yeah, it doesn't work on me. It's not going to work on Aaron either. Yeah, one of these times you're going to be serious and we're just going to keep on going. But yeah,
I
let's
would
go ahead.
believe it, except I hit the record button, so I know we're good.
All right, busted.
Busted. Okay, so I am going to head over. So hopefully you can now see my screen. Is that correct, John?
Yes, you
Yes,
can.
yes. Yep.
Cool. All right. So let me see. I got to get situated here. Okay. So what I thought we would do first is just go back through the June stocks. So we had a Max Payne folder. We also have a chart list of Max Payne candidates for July, which will be on the website. I don't know if it's been set up yet, but certainly before the evening's out, you can go in and you can download 10 charts that I'm going to go through with you over with you in just a minute. And we'll go through that numbers calculation, which is really just the Excel version that got downloaded into numbers. I'll go through some of the numbers with you and maybe go through one of the calculations to help you understand a little bit what Aaron was doing. The automated calculation for those of you maybe who didn't follow or maybe still have some questions. I'll try to go through and explain some of that for you. But first, what I wanted to do is just look back at June. Just keep in mind that when we do these events, it's always the Tuesday before options expire. So it's always the Tuesday before the third Friday. The third Friday of every month is when options expire, the monthly options expire. And so we always do this Max Payne webinar the Tuesday before. I mean, I've had questions, well, why don't we do it the Friday before? Or, you know, why Tuesday? Why not Thursday? Or why not Monday? Pick a day. I mean, you know, sometimes I've seen some of these calculations, you know, you do the calculation Tuesday. And I remember I did one many months ago on Tesla, and Tesla had gone down to, I don't know, something like $390 a share. This was many, many, many months ago. And I think this was before it's 5 for 1 split or 4 for 1 split or whatever it had. But anyway, went down like 390, and I had Max Payne calculated at 475. You know, Tesla had been getting hit really hard. And so this was as of Tuesday. So I jumped in on Thursday or Wednesday, and I ended up buying Tesla just for options. And I ended up buying it like I think it was like 398 or something in the morning. And Tesla went down to like 357. And I think I had a 10% max loss. So I had a stop in. I got stopped out on, I want to say Wednesday or maybe Thursday morning at 357. And by Friday afternoon, Tesla was back at 475. I couldn't believe it. So trying to get the right timing is almost impossible. And as we've seen many times, it's not always, you know, we don't always have a guarantee. Well, we don't have a guarantee. And many times Max Payne, we don't go in that direction. It's kind of like, you know, you get a stock that's overbought, maybe the RSI is 30. And so you say, well, it's oversold. So it's oversold and you get in, and then the RSI keeps going down until it gets down to 18, 17 before you finally start to get a bounce. That's kind of what Max Payne does. It's giving us a directional clue, but it's not providing us a guarantee. So you still have to keep stops in play. And many of these stocks that come up for Max Payne have made big moves in one direction or the other. That's why they're kind of interesting from a Max Payne perspective. Also, these stocks have to be tradable in the options market. Otherwise, I mean, Max Payne's based on options. If a stock doesn't trade options, it's not going to be selected. So there are definitely some limitations, and market makers can protect themselves. If a stock goes from 300 to 400 and everybody's been piling on calls, when you're looking at it at $400, Max Payne might be 320. But that doesn't mean it's going to go down to 320, because the whole way up, while everybody's been piling in on calls, market makers, and I've never been a market maker, I've never worked for a market maker, so I can only assume what takes place. But if everybody's buying calls, market makers can sell those calls and turn around and buy the stock. It's a covered call strategy. So they're not going to lose money if it doesn't come back down from 400 to 320. But they can make a lot more money if it does. So there's always financial incentive. And if there's financial incentive for market makers, that's when we want to be somewhat at least cognizant of what could take place. And that's the whole purpose for this session each month. It's not to try to provide any kind of guarantee. It's to calculate how much money is on the table for some of these market makers if, in fact, we see a reversal, how much money they potentially could make. And so for me, sometimes if a stock's going up a lot and I know that there's a potential for a stock to drop 10 or 15% because of options, the last thing I want to do is buy the stock. I want to wait a week or maybe a couple of weeks, let the thing settle back down. If it keeps going, it keeps going. But I don't want to jump in knowing that Max Payne is 10 or 20% below the current price. That to me is just being a little bit reckless with my money, and I don't want to do that. I want to try to manage my risk. So anyhow, looking at the June, these charts I'll show you shows the June Max Payne. So here's the June Max Payne. The way I put the Max Payne on the chart is I just go down here under overlays, and you can just pull up the horizontal line. So once you know the Max Payne, you can just put it right on the chart. Just put it in a horizontal line, 399.25. And then when you look at the chart, you'll see this horizontal line going across right at 399.25. Now, this was when we had Max Payne. So Max Payne would have been the 18th of June. And you can see Tuesday before would have been June 15th. And so June 15th to June 18th, toward the Max Payne week in June, you can see the spider heading toward Max Payne. Now, this is another example where you don't want to look at this and say, oh, it's at 424, Max Payne's at 399, it's going to drop $25. That's a little unrealistic. I'm not saying it can't happen, but it's a little unrealistic to just go in expecting that over the next 3 days, the spider is going to crash by $25. But there is a lot of money that market makers could make if we start moving in the direction toward that 399 level. And that's what it did last month. We did see some selling coming in. And when I go through this month, you're going to see the same thing. Whenever you're sitting at an all-time high as you go into option expiration week, the tendency is going to be for the market to pull back. Again, tendency, not guarantee, big difference. So I wouldn't be out, mortgaging the house because Tom's saying that there's a guarantee. That's not at all what's going on here. And as I always say, and we try to mention at least once during these webinars, we are not registered investment advisors. I can tell you that these potential Max Payne trades are generally pretty aggressive, sometimes very aggressive. And I know many of you probably are not aggressive traders. So you probably want to be aware of what's going on with Max Payne, but you may not want to trade based on it. Again, it's more education than anything to let you know, some of the things that can drive the market in the short term. We have so many short-term market inefficiencies. Eventually, stock prices are going to go where they're supposed to go based on the Fed policy, based on interest rates, based on earnings projections and growth rates, and everything that's out there gets baked into price. Price will eventually go where it's supposed to. Max Payne, we're talking about just a couple of days here, a few days, maybe up to a week. And then after that, it doesn't matter. we're talking very, very short term in nature. If you buy and hold, you tend to hold for many months, even years, I wouldn't pay any attention to Max Pain. It's just a short term market inefficiency. But if you're a trader, I think it's incredibly important that you know about Max Pain. So anyway, you can see on the spider, we actually made the move down over the next couple of days. I thought that was a pretty good call. Now the QQQ was kind of interesting because what I remember was, we had the Max Pain down here at 322.05. And you can see we were up at, 340 and change. And notice on that Wednesday, we went down to about 336. I can tell you in 1 second, 337. So it was a directional move, but by Friday, we were right back up where we were Tuesday evening. So timing is, you can be off on timing, and you may look at this and say, well, it doesn't work. I think over time, this has proven to be very useful, but on a month-to-month basis, sometimes it's going to work better than other months. So you just have to understand that it's like anything else. Again, it's like RSI 30. That doesn't mean we're going to have an immediate bounce in a stock just because we reached an oversold level. All right, let me keep moving here. So Vertex was down here, I don't know, maybe 186, 187. And we had Max Pain up here at about 208. And once again, you can look down here, 2869. So we did eventually make the move up, but during Max Pain week, option expiration week, we really didn't make much of a move. I think by Friday, we got back up maybe to 189 or something like that, but really not much movement back to the upside. So that was a long candidate based on Max Pain. Alibaba, same kind of thing. I think on Tuesday, it was down under 210. We did have a move up to about 215 on Friday. So we did kind of have a directional move. I would say that one worked a little bit. But you can see the week after options expiration, and I say this a lot, option expiration is Friday, but sometimes the Max Pain can carry over into the next week. And the reason being, if everybody is buying puts on a stock like Alibaba that's going down, if they're in the money come Friday, they can exercise that put and short the stock. Well, what happens if they do that? Every put contract is equivalent to 100 shares. Hold on 1 second. So if that's the case, market makers are simply moving from kind of a short position in the options world to now a long position in the options world to now a long position on the stock. Because somebody's exercising a put, they're shorting 100 shares. That means market makers have to buy 100 shares on Friday, at option expiration time. So the next week, you can see Alibaba exploded to the upside. That may have been the result of options. But notice what happened a week later. We go right back down to a new low. So once again, the big picture doesn't change, but short term, you got to wonder, was that Max Pain that drove prices higher in the short term before we went back down? Don't know. I know we also had Alibaba. I want to say it was either this. No, actually, it was back in April. This move right here, Alibaba was one of our long candidates that month as well. And look at it going into option expiration in the first couple of days of the next week, it went up. And then look what happened after it, right back down again. So once again, it was just a short-term manipulation. And, if you're shorting Alibaba, you want to know about the possibility of a move back to the upside heading into option expiration Friday. All right, NVIDIA. So NVIDIA last month really didn't do a whole lot to the downside, even though there was a lot of in the money. Let's see here. So if you look down here at the bottom, you'll see the horizontal line I put in was $636. That was Max Pain. Now we went in and we were probably at about 715 or so. And if you look the next day, we did go down to about 700. So we made a move in the right direction, but by Friday we had exploded back to the upside. So if you are going to short a stock because you believe it's going to go down based on Max Pain, keep your stops in play, just like any other trade. Look at what NVIDIA did. It really didn't care. And there was a lot of volume coming in here. When we made this breakout, look at the volume explode to the upside. So probably what was happening is there was a lot of calls being bought, and market makers just simply kept selling the calls and buying the stock. And, you know, with that kind of volume, that's what I'm assuming probably took place. So we had a lot of movement up and then back down and so forth. This was the Monday after options expiration. We had dropped from 775 down to about 710. Was that options related? I don't know. But I'm at least aware that it could be, because I know how many in the money calls there were. AMC. Now this one you might look at and say, well, it didn't work. But if you look back to Tuesday's close on AMC, so this would have been Tuesday, the 15th. It closed at 59.04. So this is when we did Max Pain, 59.04 on Tuesday. Wednesday, it was as low as 51.86. And then after rallying back up and getting up close to 60 or so, you can see after that, right back down again. Now, AMC was one, along with NVIDIA, that I did a calculation on this month. We'll talk about that in just a bit. But again, did it go from 59 to 31? I mean, because that's where Max Pain was down here, 31.97. Of course not. Again, it's sitting at 59. The chances of a stock going from 59 to 31 in 3 days, I'm not saying it can't happen, but probably not. But it also, I wouldn't want to buy the stock at 59 knowing that Max Pain's 31. And that's more my point. To me, it just provides us more information on whether to place a trade or not place a trade. And I think there was certainly enough information here to tell you you don't want to go long AMC with all of these in the money calls. Now, again, that was last month. We'll talk about this month in just a minute. All right, DocuSign. I also updated DocuSign for this month. But DocuSign in June came up here, and you can see option expiration week. Really, I mean, we had one day on Wednesday where it moved down a little bit, but look at Thursday and Friday. It exploded to the upside. Got to keep your stops in play. Max Pain was all the way down at 223.58. So way down here. And we were up over 250 when we had the, or maybe just on right around 250. And so the next day it went down to maybe 247 before it went higher, but it really didn't work. I mean, I would look at this one and say this one really didn't work. Moderna, another one that we were looking for maybe a pullback, and you can see option expiration week, it did pull back a little bit, got down to like 195 or something. And then once options expiration was over, it took back off again. So your short-term move is to the downside, but if you're holding for the long term, in my opinion, you shouldn't let Max Pain sway. If you like the chart, then you stick with it long term. But as a trader, it would have been very easy to move out of it and then maybe think about getting in, whether it's a 20-day test, whether it's maybe coming back down to the breakout, which it never got down that far. But you know, as a trader, you can make those decisions. All right, and that was it for last month. So those were the ones that we gave last month. So I'm going to go through the ones we give this month. And then I'll pull up my numbers spreadsheet, maybe just show you the calculation on one of them. I think Aaron kind of already went through the calculation, but I'll explain it maybe in a little bit more detail so that that spreadsheet, if you do work with it, maybe it makes a little bit more sense for you. But let's go ahead and go into July 1st. So we're going to start with the spider. So once again, these horizontal lines that I put in are showing you Max Pain. So in the case of the spider, Max Pain, remember Aaron came up with 421.91. I have 421.92. So we were off by a penny. And we're doing that test. We did it on a number of stocks just to see if we're close. Now, what I do when just in an effort to save manual labor, sometimes I won't put all of the open calls and puts in, like ones from many, many strike prices ago that only have like 3 contracts or 2 contracts. There's not going to be a lot of value in those. So I would skip those when I was doing my manual calculation. But as Aaron showed you, she downloads that information, the CSV file, everything, every strike price gets entered in. So in theory, it's a much better calculation than the one I do. So we were off a little bit on some of them that we did, but not much. And I'm sure it was because of my manual calculations and the way I did my manual calculations. Anyhow, so when you look at the spider, we're sitting right now at 435.59. We had a pretty good reversal today, by the way. Got up to 437.84 and closed more than $2 off that high. So is this a top? Are we going to go down to 20? Are we maybe even going to sell off more than that? I don't know. Max Payne says we could, but Max Payne will say this every month pretty much if we're going higher. And this is why, for those of you who've been members of Earnings Beats for a while, or maybe just followed my work for a while, you know, from a historical standpoint, I always talk about the 18th of the month through the 24th being, or 25th being or actually it's the 19th through the 25th being a more bearish time of the month, calendar month. Well, most of that I think is because of options expiring. We tend to go up in the middle of the month through the 18th, and then that's about when options are expiring. And then we tend to pull back. And long-term historical analysis backs me up on this. So we're getting to that point where I think it's worth at least being a little careful. You know, look at February. As we, went through the middle of the month, we rolled over. January, we got a little bit of a rollover, one last push to the upside and then rolled over. March, we get to about the 16th, 17th, we roll over. April, we get up to about the 18th, go side. Well, we roll over first, but essentially we go sideways. May, we probably went up a little bit that week in May. But I think if you go back and study history, you'll see that there are many months when you get into that third, fourth week of the month, calendar month, the market tends to struggle. Now, does it change the overall uptrend? No, but it's a short-term market inefficiency that you need to be aware of. So I wouldn't be surprised to see the spider roll back over again, if not this week, possibly into the early part of next week. We know the market tends to do well heading into earnings season. Well, earnings season just started today. JP Morgan was out with their earnings, Pepsi out with their earnings. So we're starting to get them. We got a bunch of banks coming out tomorrow. I think Wells Fargo, Bank of America, PNC, Citigroup, I think all of them come out tomorrow. So as these numbers start to come out, a lot of times we see buy on the rumor, sell on the news. So as the news starts coming out, don't be surprised if we see some selling. All right, so that's the spider. Let's go to the QQQ. Well, here's your Max Payne. Max Payne is at 347.51. So, I mean, if you look at the chart, I'm never surprised to see a 20-day test during an uptrend. So who's to say, we had a breakout earlier today and we came back down, closed near the low. Who's to say over the next couple of days we don't come down and hit a 20-day test on the QQQ? That would just be a normal technical behavior. Nobody would even bat an eye. But if you're a Max Payne follower, you'd be batting an eye. You'd be saying, hey, look at the millions and millions of dollars market makers are saving. That's what you have to be aware of. All right, first long candidate. So these are stocks that have been going down recently that might get a bounce either later this week or into next week because of where Max Payne sits. So the first one is Walgreens Boots Alliance, WBA. Max Payne's $50.58. Right now we're trading at $47.32. So again, would anyone bat an eye if we just moved up and tested that 20-day EMA and then rolled back over again? That would help to save a lot of money for market makers if we got just a couple dollars out of this move to the upside. Carnival Corp. This is another one. Max Payne is up just under 25, 24.87. So with Max Payne at 24.87, that's simply kind of going back up to where we just broke down from. Normal TA 101. Broken support becomes resistance. So if we get a pop at some point over the next few days to a week, that could be saving a lot of money for the market makers, technically not really doing anything on the chart. Next up, we're going to move to some of these potential short candidates. So NVIDIA, I mentioned last month, didn't really pan out. We had a lot of volatility, but for the most part, we didn't see a lot of selling. I think this month could be a little different. I just see a little more deterioration in the chart. Like last month when we were moving up, the PPO was still grinding to the upside. Now we've seen enough weakness where the PPO has rolled over. I still believe probably the 20-day is going to hold, at least initially, before we get a pop. But the 20-day right now is at 777, which is $33 below current price. That's about 4% for the stock. So could it lose 4% over the next couple of, I mean, it could lose 4% at tomorrow's open. We know how fast these growth stocks can move, but that would save market makers a lot of money if it did. So again, that Max Pain numbers all the way down here, which is at 719, could it go down there? Yeah, it could. But I'm just more interested in the fact that I think directionally, the probability is that we're going to see a pullback here. So if I was looking to enter on the long side NVIDIA, I'd wait. I think the odds favor it going lower. Doesn't guarantee it. I'm talking probabilities here. But knowing what we know, I kind of see a nice reversing candle there, that bearish engulfing candle, moving back up, lighter volume. I wouldn't be surprised to see another little ABC correction. I think we're going to see this one on the 20-day. It's just my thoughts based on, the Max Pain along with the technicals. AMC, we're sitting almost right on Max Pain right now on the AMC. So there's not really any advantage to the market makers to go in either direction. Maybe that's good news for you if you've been in the AMC, wondering if it's going to go any lower. If it starts moving much lower, then you're going to have a lot of in-the-money puts starting to build. And the in-the-money call premium for all the folks that bought lower will start to shrink. So all of a sudden that Max Pain is going to be much higher than price if we fall very much. So something to keep in mind there with the AMC. So we closed at 39.35 and the Max Pain's 39.14, almost right on it right now. DocuSign. So that candle from Monday, that's a shooting star off of an uptrend with a negative divergence. DocuSign is showing technical signs that it's ready for a pullback, and it was down today about 1.5%. But you can see we do have Max Pain just around that 260 level, comes in at 260.30. So maybe at least a test of the 20-day, maybe more, given that negative divergence. Here's the breakout of this high right here at about 265. So maybe we go down to there. That would be getting us close. This is one that I'd be a little worried about. I definitely would not be getting in on this stock on the long side. Again, doesn't mean it can't go higher. Market can do anything it wants to do. So I would never treat anything as a guarantee. But I have enough warning signs here to tell me to stay away from DocuSign. I might be able to get it cheaper if I want to enter on the long side. Nokia, this is one I mentioned in the daily market report today when I sent it out. Sitting at 588. I mean, it was a nice breakout today above these recent highs. Great volume. If it weren't for Max Pain, I would definitely be thinking long here. I'd be thinking, it's got a good shot to run up to 650. But there's a lot of in-the-money calls on Nokia right now. And there's a bunch more at 6. A lot of folks were piling on at 6 today, thinking that we're going to just keep going. If we reverse, all those folks buying calls at 6, they'll all expire worthless. And everybody that's been buying 5.5 and 5, a big reversal could wipe out a lot of that premium as well. In fact, we'll take a look at Nokia on the calculation. I think this will be a good one when I pull up the numbers in just a minute. But Nokia's Max Pain right now sitting at 473 and the stock is 588. So yeah, it looks good technically, but man, I would have a hard time pulling the trigger on the long side right now. If it gapped up tomorrow, it would just be further and deeper into the calls and all. And so after a gap up, I'd be maybe thinking we're going to reverse if we gap up in the morning. But again, no guarantees. 2 more. So Tesla. So these last 2, Erin ran. She ran some other ones as well. She ran DocuSign and I think NVIDIA. So we were just checking to see if we were pretty close. But those are two that I actually did the calculation on manually on the Excel spreadsheet. But these last two that I'm going to show you, Tesla's one of them. Aaron did. I did not run this one. There's so many strike prices. I have tended to avoid Tesla's calculation just because it would take a long time manually. But now that we have this tool, it doesn't take any longer to do Tesla as it would Nokia, which has very few strike prices, because all you're doing is copying and pasting. Might take a little bit more time for Excel to calculate it because there's a lot more calculations involved. But the manual part of what you need to do is not really any more with Tesla as it would be with any other stock. So that's a pretty cool feature of the tool that she gave you the demo on earlier. So Tesla, you can see Max Pain on Tesla sits at 641. Tesla right now is at 668, and it reversed. It was down 17 today. So maybe this is already a start to taking out some of this net call premium. Now, if it were to get down, you can see I put this arrow in just this recent low, because if you look at the open that day, we opened at 628, closed at 652. We got both these moving averages that are going to be tested soon. Yeah, I mean, this, moving down another, we went down 17. What if we go down another 17 tomorrow? All of a sudden, all that net call premium has just about evaporated. And I'm going to give you the numbers here in just a minute, but I can tell you this. No, I can't do it right now. I'll show you in a minute. But the amount of in the money call premium, you need to kind of at least know how much money is on the table. The ones that have more and more money on the table are ones maybe I would look a little closer at. All right, and then the last one is Zoom. So Zoom isn't too far above its Max Pain. Max Pain actually is 365.49, and we finished at 378, so another $13. We would be down to Max Pain. And we're sitting on the 20-day. This is where I normally would be a buyer technically. But knowing that Max Pain's a little lower, if I was buying Zoom, maybe what I do is buy half. And then if we did get down to 365, maybe buy the other half. Or if we, whatever the number is, maybe it's 370. And just using any Max Pain related weakness to our benefit to get in a little bit cheaper. Or maybe you don't like Zoom, which is fine. I'm a fan. I think Zoom has bottomed. I think we're now starting a new uptrend. So I'd be interested in buying it on weakness. And full disclosure, I do own Zoom. I'm out of a lot of stocks, mostly because of Max Pain. So I've gotten out. I was in Amazon for a bit. I was a little nervous with Amazon, so I got out earlier today after it started selling off. Same thing with Tesla. But I'll look to get back in. If it goes up, I might have to buy back in higher. If it goes down, I'll be able to get in a little bit cheaper. We'll see what happens over the next couple of days. But that's, again, me using Max Pain, not guaranteeing it's going to go lower, but just not willing to risk my capital. So if it goes up, it goes up. I might find other stocks I like, or I might buy in higher. I don't know. We'll just kind of play it by ear and see how it's trading. But for me, capital preservation is job one. And when I get close to Max Pain time, like I said, Zoom doesn't have a whole lot of downside, so I was willing to hold on to this one. But there are some others that I just felt like, I wanted to be a little more careful with. All right, so those were the charts. The last thing I'm going to do, and then we'll wrap this up. It's hoping to be done by about 5:30, but this won't take but a second. And it's more kind of giving you a little bit more discussion relating the calculations, and maybe give you a little bit more background as to what Aaron was doing earlier with the demo. So I'm going to start now. When you look at the close here today, and then the Max Pain price, these are all things I just showed you on the charts. So really what I want to do is focus on two things. First, this right here gives you the net call put premium. So these are the amounts that currently is at risk. So for NVIDIA, for instance, $785 million of net in the money call premium. 785 million. Now, it doesn't mean that market makers are going to lose 785 million if prices don't come down. Don't misinterpret what I'm saying. keep in mind that, again, market makers can use a covered call strategy. So when everybody's buying the calls on the way up that resulted in this value, market makers can simply buy the shares and own the shares. So they get that money back by owning the stock. And they actually make a little bit because of the premium on the call. So don't worry about market makers. They're not getting hurt. Trust me on this one. They'll be fine. Let's not, we're not going to have a GoFundMe page for the market makers. They don't need it. But what happens if they were buying the stock to the upside and now they start selling those long shares that they own and even take a short interest, start shorting? They can make money on all those long shares they had on the way up. They can then sell those shares and start to short, driving the price lower, making money on their short position and saving some of this $785 million that they got to pay out. They get money on the way up, they get money on the way down, and then they get a little bonus in terms of options. It's a win-win-win. And when they've got this kind of money on the table, I definitely would not be a buyer of NVIDIA right now just because of this number. And that doesn't mean anything. NVIDIA might be $850 by Friday, just like it was last month. But this tells me the risk is too high and I don't want to take this risk. So just understand all of this is about managing risk. It's not about providing guarantees. If I was going short NVIDIA because of this calculation, I'd have a stop in probably above whatever today's high was. If it just breaks out, I'm not taking any chances, even though it might break out and then turn right back around. Remember the story I gave you on Tesla, where I got stopped out with a 10% loss 2 days later, went right back to the target I was looking for. Sometimes just bad luck. You make a good call and you get in at the wrong time. That's trading. So you can see NVIDIA is a big one. Look at Tesla. I mean, all it's got to do is go down $37. Now, these numbers, all these numbers I put in here for my calculations were as of the close today. Tesla and Zoom, these were numbers that Erin used in her calculation middle of the day today. So whenever she did the calculation, Tesla was sitting at 678. Now it's 668. So it's already come down $10 of the 37, roughly 1/4 of this 563 million is already gone. So what would that be? That would be 140 million, maybe not quite that much. Already saved. Are market makers shorting to drive the price down? I don't know. It's very possible. But then you look at Zoom and there's only 16 million available on Zoom versus 563 million on Tesla, 785 million on NVIDIA, 895 million on the SPY, 625 million on the QQQ. So again, there you can see the variance. Nokia, even though it's projected to potentially lose 19% to get down to max pain, it's only $9 million of value. So, there's different metrics here you have to be aware of. So what I'm going to do to wrap up is let's just take a look at the Nokia max pain calculation. So current price is 588. And as Erin was showing you on the demo, this is what we're trying to solve for. We're trying to solve for the max pain price. Now, what I end up doing in my calculation, because here's what the current value says. If we finish on Friday right where we are as of Tuesday's close, and there's no change in the open interest. Of course, there will be plenty of change in the open interest, but I'm just talking about a perfect world. Nothing changes between now and Friday. There will be $9.2 million of net in the money call premium that would have to be paid out. Now, the idea with max pain, this calculation, is to figure out at what point, at what price we would have to drop back to so that the call premium at that price would equal the put premium, net put premium at that price. And they offset each other to zero. Here's that seesaw. So you got 2.4, almost $2.5 million on the left side of the seesaw, 2.5 million on the right side of the seesaw, and they're perfectly balanced. Whereas now you got a lot of call premium, 9.6 million, and put premium is only 435 million. So the idea is, where does price have to drop from $5.88? At what point would all of that net premium be gone? And that point is $4.73. Now, this spreadsheet, last thing I'll point out here, is the way you calculate this. If you wanted to just do the manual calculation, maybe understand what this is telling us. It's saying that there are 800 open calls at a strike price of 2. So if you're lucky enough to have calls on Nokia at $2 and it's sitting at $5.88, you're $3.88 in the money. You have the option to exercise your call and buy the stock at $2. So you can either cash in your call or you can own the stock. If you really like the company, you don't have to pay taxes if you exercise the option. That's one incentive. If you were lucky enough to get it at 2 and you're like, man, I want to hold this long term, you can now buy the stock at $2 and you still own the stock and your basis is still intact. And for tax purposes, you don't have to, you just transferred what you paid for the option over into the cost of the stock, and you still got the stock going forward. So that's one incentive why somebody would exercise and own the stock instead of just outright selling the option. So the way you calculate this premium here of 310 million is you have to understand first that every call or every put can be exercised and converted into 100 shares. One call equals 100 shares. So when you calculate the value of the calls at this strike price, you take the in the money value, 588 minus $2, which is $3.88, times 800 calls times 100 shares, because for every one of these calls, there's 100 shares. So, or you would just adjust the calls from 800 to 80,000, which is multiplying them times 100. Either way, you're going to come up with this call premium of 310 million. You do this for all the strike prices, and then you do it for the puts that are in the money. Now notice there's no call premium at $6. Now, if you went and looked at the price of what calls are going for right now for $6, you'll see that there's a little bit of value in there, probably 15 or 20 cents. I don't know what it is, that you would have to pay. So you might say, well, why isn't that value here? But again, what we're doing is we're taking the current price of 588 and we're making the assumption that this is now Friday and we've closed. There's no time value anymore. And if we make that assumption at Friday, if we're trading at 588 at Friday's close, if you're holding a $6 strike price, it's worthless. Why would you buy the stock at $6 when you can buy it for 588? So that option is worthless. $6.50, $7, same thing. So all of these call options are worthless. Now on the put side, if you own puts, if you were fortunate enough to buy a put at 7, then you're now $2.27, or excuse me, no, you're $1.12 in the money. So you take that $1.12 times 80, or excuse me, puts times 3,578 puts times 100 shares, and that will give you your value of 400,000. So you just go through this calculation. There's your net value, and then you calculate the max pain by figuring out, and that's what the Excel tool that Aaron put together. That's what this max pain will do. It'll do those calculations for you automatically, so you don't have to do it manually like I do in my head. Anyway, I just wanted to make sure everyone's aware. So if Nokia all of a sudden were to drop $1, if overnight, I don't know, maybe tonight or tomorrow night, maybe they come out and they have a secondary offering. All of a sudden, stock could be down 10 or 20% on a secondary offering. I'm just saying, I don't know whether there's going to be news that comes out or not. But what I don't want to do is jump into the stock at 588, knowing that market makers could make a fortune if it goes to 473, or even if it goes to 573 or to 553. Anything will be starting to erode this value right here. So any directional move toward 473, and market makers can make a lot of money. Now, if it goes to 688, again, don't feel sorry for the market makers. If it goes to 688, it's because a lot of folks are still buying the calls. Market makers are selling the calls. They're buying the stock. They're fine. They're not being hurt. So it could go to 688. But man, there's a lot of money on the table for them to turn that thing around. And so there's financial incentive. And that's what Max Payne's all about. That's why we do this every month. And hopefully if you're new to this, maybe your eyes opened a little bit, because from a short-term market inefficiency standpoint, option expiration is a huge deal. And there's a reason why the S&P 500 since 1950 goes down, has an annualized negative return from the 19th of the month through the 25th of the month. Now, I haven't gone back, options expiration Friday can fall anywhere from the 15th to the 21st. The third Friday can be either the earliest the third Friday can be is the 15th. That means if Friday's the 1st, it'll be the 8th and the 15th. If Friday's the 7th of a month, then the latest it could be is the 21st, 7th, 14th, 21st. So 15th to the 21st of every month, options will expire. And I think this whole 19th to the 25th is just because of the fact that options get exercised, and you can have some of this carry over into the following week, because market makers, if they're short on the short side of calls, if those calls get exercised, now they're on the short side of the stock rather than the option, but they're still on the short side. So they still going in the next week behooves them to move prices lower. And I think that's why the 19th to the 25th is as weak historically as it is. All right, that is it for me. So I don't know, John, do we have any questions before we wrap up?
Yeah, let's wrap it up with this one question. Does it make sense to run the calculator that was presented for your stocks of interest after the close every day before Friday?
That is a great question. And
Yeah.
Max Payne will change. A stock like Nokia, this is one that I think, definitely could change, because I think you could get a lot of calls and puts, that continually update at the end of every day. We don't do it because we're not going to have a webinar 3 days in a row talking about Max Payne, but certainly with this tool that we now have, you could recalculate your stocks every day if you wanted to. If the stock keeps going up, and you think it's going to come down, you could rerun it at the end of the day and see what that move to the upside, what did that do to the Max Payne? Sometimes it won't do much. Sometimes it'll do a little bit more. But I do think these stocks that move more wildly, like a couple months when Plug didn't work for us, as that thing moved down, continually moved down, that was one that kept going lower and lower. It was down to like $32, I think, when we talked about it on Max Payne, and literally within a few days it was 25. I mean, it just kept going to the downside. It didn't work. And so some of them aren't going to work. You want to keep your stops in play. But then it finally did make its move to the upside. I had gone back on Plug a couple days later and recalculated, and Max Payne had dropped from like 38 or whatever it was, or maybe it was even in the 40s that month. I can't remember, but it had probably dropped $10 or $11 in 2 or 3 days, Max Payne. Because the other thing is it keeps dropping. You got more and more in the money puts that are going to be traded, and some out of the money puts and so forth. And it changes the whole dynamic. So it does make sense, especially with volatile stocks, to go ahead and rerun it. That's a really good question.
All right, that's it, my friend. Time to wrap it up.
All right. Yeah. Certainly appreciate everybody coming in. We always, we know we do a lot of webinars. We do it for educational purposes. We really appreciate you taking the time to come in here. Hopefully these things help, teach you a little bit more about the market. Maybe you're already aware of it. Maybe we're just tweaking a few things to help in your trading. But I want to make sure that our members are very well educated on a lot of these short-term market inefficiencies, especially if you like to trade short term. So with that, we're going to go ahead and wrap up the July session. Again, what Aaron went over earlier is on the website. We do limit that to our annual members. And I'm going to end this with one more thing that hopefully everybody can you see this screen, John, my charts?
Yes, you can.
Okay. All right. I'm going to go over to earnings beats because we do have a webinar special. I didn't mention this earlier, but it's an annual special. So if that tool is something that you really are interested in, that's just one of the many features that we offer to annual members. You can also get our industry group relative strength chart list, which has 104 industry groups. You can monitor the relative strength of every industry group along with the sectors. But anyway, and if you're paying monthly at 147 a month, if you really like our service, you're just going to save a lot of money by doing the annual $997. So we have this webinar special where not only will we give you 12 months for $987, but we're going to throw in a 13th month. So you get 13 months for $997, which cuts the cost for, if you're looking at it from a monthly perspective, it cuts the cost by almost 50%. So this is good and through tomorrow. So you got one more day to take advantage of this annual special. So if you like what we do and you're starting to get used to our service and how you can benefit from it, make sure you take us up on this webinar special, which will expire tomorrow. All right, that's it. Again, want to thank everybody for tuning in. We'll do this again next month. And until our next webinar, everybody have a great day. Happy trading.